every negative about a business, if you solve it, if you buy it at the right price, every negative becomes a positive, because when you solve it, the business becomes more valuable. It's not just about the quantity of earnings, it's also about the quality of the earnings as well.
Hello, fellow data nerds. My guest today is Brent Beshore. Brent is the founder and CEO of Permanent Equity. They buy cash-generating small and medium-sized businesses with the intention of holding them forever. Permanent Equity owns over a dozen businesses in sectors including aerospace, building and construction, and martech. Brent, welcome to World of DaaS.
Hey, thank you for having me on. I appreciate it.
Really excited. Now, what experiences turned you off from traditional private equity?
Yeah, that's a great question. I never really had experience in traditional private equity, to be honest. So you may laugh at this, but I can remember I actually bought my first business, and a friend of mine from college said, "Oh, you did a private equity deal," and I literally Googled private equity, and I was like, "Oh, wow. I'll be damned! Who knew? There's a whole industry of people who buy these companies." So yeah, I joke that I'm the Forrest Gump of private equity for a reason. Literally, I didn't even know it existed. So what did I not like about traditional private equity? I just didn't know it existed, and so tried to do something from first principles, and it seemed to work out.
And from a first principles perspective, now that you know a lot more about private equity, what do you think one should be doing much differently from a first principles perspective?
Yeah, well, so if you look at the model of Permanent Equity, the firm that I founded and run, in many ways, we're almost the exact opposite of private equity. In fact, I remember during our last fundraise, an institutional investor, we got through kind of the conversation, and he said, "Let me just get this straight. You're telling me that the opposite of private equity is going to return me more than traditional private equity?" And I was like, "Yes, I think that's exactly what I'm saying." So if you look at traditional private equity, what do? They acquire with as much debt as they possibly can. They typically will change out leadership pretty quickly, bring in new leadership, change over the firm. They'll probably know who they want to sell it to. They'll try to go through a period of rapid change and then resell the company to another firm within a fairly short period of time. So if you look at our model, we buy with no intention of selling the business, and we can determine, we can talk about it a little bit later. That doesn't mean we will never sell. We actually have never sold, but it doesn't mean we never will sell. It just means we have no intention of selling the business. We typically use no debt in our transactions. We love to work with people who are already in place.
Okay, so you're doing all with equity.
Yeah, we're using 100% equity when we do our deals.
Why is that? Because that is really kind of the essence of private equity. Yeah. Private equity used to be called a leverage buyout. That was the name before they rebranded it.
Absolutely.
Private equity. And that was, so the whole idea was to buy these things with debt. Why did you decide that that's not a good thing?
Yeah, well, so my background, I was an operator before, right? I founded a number of companies, and I was the CEO. I just couldn't imagine the pressure of trying to run a small company with a bunch of debt on it. I mean, it is already
just layering on the debt. Yeah, even a big company.
Super stressful.
So I have friends who are running private equity backed. They're private equity backed CEOs, and all they think about is making dealing with the covenants, making their debt payments. It's a huge thing that's in the back of their head.
Yeah, absolutely. And so if you think about it, in our area of the market, the businesses are already struggling in a lot of ways, right? I mean, if we're typically purchasing the company, it's between kind of 3 on the low end of earnings a year and call it on the high end 20-ish of earnings. So these are fairly small businesses. I mean, they're heavy cash flow. They're very successful. Yeah. But they're still small and they're resource constrained. And when you take all the resources that you're going to be generating to try to grow the business, hire people, compensate them well, just have some margin of safety, and you're going to pull all that out and send it to a bank, it doesn't leave much margin of error for anything else. And so we actually think that our model returns, on average, over a long period of time, a higher return because you're able to take advantage of cycles in a way that you wouldn't otherwise. I mean, let's just take a step back. I mean, this is an area that probably anybody in finance who knows what they're doing will probably most disagree with me on. But let me give you an example. So if you know exactly what the future holds, you should try to leverage the business up as much as you can. I think that it's been proved out over a long period of time, not the first person to say this, that the world is unknown and unknowable. For the most part, you can't predict what was happening. I don't know many people who are like, oh yeah, we're going to go through a global pandemic. Everything's going to be turned upside down, right? Whole lives are going to be turned upside down. As an example, in that particular area, we bought up an aerospace business in the fall of 2019. Now, I don't know if you know this, aerospace businesses never go down. The industry never goes down. It always is at least flat or up. And
Okay.
so I remember when we were buying that business, one of the people, the advisors on that deal was like, you guys are morons. Like, you are the first people I've ever seen in my entire career to not use debt in buying an aerospace business. And we were like, yeah, we're idiots. Yeah, sorry. And they just didn't get it. Now, what happened in 2020 obviously was a hopefully once in a lifetime event, but it's indicative of what's possible. We were the only ones that didn't have debt. We were the only ones who retained cash flow positive status the whole way through COVID. We were able to make 10 years of progress in 2 years because we were able to hire people no one else could hire, reinvest. We weren't dealing with the bank all the time. We were able to run the business the way we think it should be run. And now the fruits of that are the business is much larger, much more successful than it's been. If we'd had debt, we couldn't have been able to do that. Now, would we have had higher returns on equity on paper when we had done the modeling? Yeah, of course. Like, the math's not hard to work out. It's not like we don't know how to do the math. But the point is, most of these businesses are highly cyclical. Most of these businesses will go through shocks. The world is unknowable. And so we want to be able to, when everyone else is having to deal with banks and everyone else is retreating, we want to be able to take steps forward and really gain ground.
Yeah. Okay. Interesting. Right. In potentially, if you're doing with less debt over a long period of time, in like a base case or a bear case, like, you're going to do better. And then if there's like a bull case where the company does super well, maybe you do worse. Or it really depends on how the model kind of works out. It also depends on your time horizon. Right. And so, if you have a 30-year time horizon, typical private equity firm has 4 to 5 years or something, then you're also going to have a different way of modeling it out as well. What are some other like non-obvious lessons you've learned after your first kind of dozen acquisitions or so?
Boy, great question. So I would say I like to joke about this, but it's really true. All businesses are loosely functioning disasters, and some happen to make money.
Yeah.
I mean, I've seen a lot of businesses. Some are larger, some are smaller. I've never seen a business where there's not constant chaos and disorder going on. I mean, they're people. Businesses are people.
I have never seen a well-run company ever in my entire life. Right?
Yes.
The best company I've ever seen is like mediocre.
And this should encourage
including
us.
all the ones I've run. Like, I've never run a well-known company. I've never worked in one. I've never seen one. Like, they're actually always like way more messed up than people think.
That's exactly right. And by the way, this should be an encouragement, because I feel like when I say this, sometimes people think I'm being condescending. I'm like, look, I'm saying this about our company as well and the organizations that we own. Like, we have constant disorder and chaos all the time, and people are messy. When you get a bunch of messy people together, it's going to be a mess. And so what we like to say is, okay, look, the more disordered and the more chaos we're stepping into, as long as we know we can try to predict the chaos and we know what the chaos is going to be, the more that we can look at that as opportunities. And so, I remind this of our team all the time. But once we close, I mean, we've never had a deal where we closed and not found something weird, hairy, unexpected after close, ever.
Yeah. Yeah.
And so it's a form of humility to pay a lower price. It's a form of humility not to use debt. And it's a form of humility not to assume that you know what you can do with it post-close. Those are all three kind of core tenets of what we do. We try to go into it with high humility to say, look, we're going to try to serve the people well. We're going to try to serve the customers well, all the stakeholders. We hope to have a win-win long-term. But we need to get to know the business. We need to know what's there, and we're not going to lever it up. We're not going to try to flip it within a short period of time. We're not going to come in and have a 90-day plan where it's like, look, yeah, sure, you've been running the business for 15 years and you know how things go. We've seen some data. We've seen some due diligence. And now we're going to tell you how to run the business, right after close. It doesn't make sense to us. So I would say just one in general is that businesses are loosely functioning disasters. I would say another one is most businesses, and often careers as well, die by suicide, not by homicide.
Yeah.
So I would say, when I look at real
competitors don't matter as much.
Competitors don't matter. And even in careers wise, it's not that your career suffers because somebody else outcompetes you. It's often that you do something stupid, or you just can't see past your own limited perspective. And so, really most businesses are capped by the willingness of the leader to be humble and to learn. And frankly, it's very rare to find somebody who has been quote unquote successful, right? I mean, if we're buying the business is making a lot of money. I mean, these are the chairman of the country club. Like, these are the kings of their regions. These are people who everyone looks up to. it's super rare to find people who we get into business with, who we want to buy the business from, that are humble and generous and gentle and kind. And I mean, those are the people we're looking to be in business with. But oftentimes, I mean, they think they're experts at everything and there's nothing to learn. And that's why the business is capped. And ultimately, that same mentality cascades down into the leadership of the firm and ultimately into the employees as well.
When you're looking to buy a business, what do you think are like the non-negotiable things? Like you must have these things, or they must not appear to buy, that are maybe a little bit less obvious.
Yeah, I mean, I would say a core business model that works, right? So we're not buying things that need to be proven. And by the way, there are some private equity-ish firms that will take flyers on things. I mean, I don't know how many scooter businesses that we saw over a 2-year period, but there was a lot of like money sloshing around in like the, making scooters, renting scooters, doing fleets of scooters. I mean, there was this whole like scooter rush.
Okay.
And we saw a bunch of these businesses that were like, they'd gone
Well, I
from
presume
making
you're buying businesses that have been around for a while in general, right? So you're not buying a fad. If something's only been around for 2 years, it's hard to know how it's going to appear. Where if it's been around for 20 years, it's a little bit more predictable.
Yeah, but I'll give you the exception to that. So like on the scooter business, like, obviously there's a whole VC crush on the front end to a bunch of these, right?
Yep.
Scooters were going to be the next everything. And but what that actually created was a cascading downward effect. And what you maybe didn't realize is even in the small business world that we're in, we saw scooter deals. We saw scooter deals of scooter companies that were, they were previously making something else. And for a long time, they added the scooter market.
Or they're servicing
or they're
things
servicing
or whatever.
scooters, or they're making the parts that go into scooters or whatever the thing may be. And so we saw companies that were, they're making $500,000 5 years ago. They made $1 million. Then all of a sudden they made $4 million, $7 million, $12 million. And right, they're trying to sell these companies. And so what we would say is that's a business model that's still unproven. So anyway, first one, proven core business model that works, people we can work with. I would say size is meaningful for us. So we see a lot of deals these days that, frankly, just the size that we're at, we just can't do. There was a date and time. The first deal I ever did was a sub $500,000 a year free cash flow deal. It just doesn't work for us anymore to buy those types of businesses unless they're very on the higher growth end and we have a specific purpose for them.
Or one of your businesses buying those businesses, or
correct,
like
as a bolt-on, but as a standalone business, it doesn't make sense for us. And then this is one that's maybe obvious, maybe not, is a seller that's willing and able. We have a lot of businesses that we look at where the seller is just playing around, that they want to kind of like feel good about their business. They're bored with their business, so they go out and they're like, oh, I'll see who wants to potentially flirt with me.
Yeah,
those are the worst. So we like to have somebody who's serious about wanting to do something, and that there's some event that's sort of forcing them to move forward in some way.
On the flip side, what do you think some buyers would say are like huge weaknesses that you can overlook?
Let's see here. I would say non-recurring revenue is a big one. So most buyers in private equity love non-recurring revenue. They are they're excited about that as a category. And look, for very good reason. The predictability of recurring revenue, all things told, is better. It's more predictable. I would say that we are much more comfortable that if the business model itself is predictable overall. So I'll give you an example of this. We own a pool business in Phoenix, Arizona. Yeah. It's an oven. Like swimming is not a luxury; it's a utility out there, right? Like some of the homes that we put pools into are like, the pool is 50% of the home value, right? These are like necessary things.
Yeah.
Once you sell a pool, it's not like you're selling a recurring revenue pool every year, right? You build it and it's one and done, but the predictability of the demand for the pools is constant. So I think there's people oftentimes will look at something like that and say, oh, well, there's no predictable recurring revenue there, even though the revenue is fairly stable over a very long period of time. Another one that I would say,
the restaurants don't have like recurring revenue. Right. Most businesses, most businesses don't have. Even investment banks don't have recurring revenue, right?
Exactly. Yeah, and so I would say, maybe the other one that we are able to get much more comfortable with is just general lack of professionalization. And maybe this is from, we didn't start.
It's just like the old, it's still on some old QuickBooks thing somewhere. And
man, you would be shocked. We've looked at deals where, frankly, the people who've been running it for a long time don't understand basic accounting. And so their books are just wrong. And we
Yeah.
come in and we ask basic questions and they're like, oh, shoot, we shouldn't have been subtracting inventory. That's like, we should be capitalizing that. And we're like, yes, that's called tax fraud. And they're like, oh, sorry about that. Well, yeah, our books historically aren't correct anymore, right? Or you
Yeah.
come in and like, when was the last time you did a count on your inventory? We've never done a count on our inventory. Well, how do you know if it's there or not? Well, we sell it and then we just go back to the warehouse. And if it's not there, then we tell people, sorry, it's not there. It's like, great. Like, how do you value that business? So, I mean, there's ways that you can get around these things, but I think most people want, I mean, like I would say a down the middle private equity deal is, a professionalized team that's used to working with professional money.
Yeah.
They have repeatable systems in place already. It's built to scale. Everything's kind of teed up, tied with a bow, and you're just going to pay for it. And again, we talk about this as a team a lot. Every negative about a business, if you solve it, if you buy it at the right price, every negative becomes a positive because when you solve it, the business becomes more valuable. It's not just about the quantity of earnings; it's also about the quality of the earnings as well.
How does one go about like building some sort of repeatable motion to find engage with a ton of these small businesses?
Yeah, I mean, look, this is the difficult part about building a firm. I mean, as I like to say, buying one company is brutally difficult. Like if I was going to start from scratch, even knowing what I know now, I would budget 3 years to find the right opportunity and close it. And then you've got to run that opportunity. You've got to cash flow it, or some people sell it, and then you got to start over again. It requires, how do you find finding good people and building repeatable systems. And I would say that, probably the thing that's most enabled our success is the fact that we were capital constrained and resource constrained for a very long time. I mean, we toiled away in obscurity, kind of honing our craft for the better part of a decade before we took on outside capital. And, at the time it felt slow and monotonous. The years would go by and you'd say, golly, we didn't do a deal again this year. Didn't feel like we were making much progress. But what we were doing is we were building culture, we were building systems, we were building relationships. And so I think that's just the hard work that it takes to, build a firm.
But I mean, in some ways, a firm, you're selling yourself. Like you're going out, just like a sales team goes out and finds, the enterprise sales team goes out and finds deals. Like you're out there, like I assume you're out there constantly, like selling yourself to potential acquisitions.
Yeah. So what makes us a little bit different is we typically don't go outbound to anybody. What we think is, and this is something we've learned from operating businesses, is that we want to attract the right people and repel the wrong people. Well, how do you do that? It's through content. It's the only way to scale conversations. And so most people are coming inbound to us. I mean, the exceptions are we have a group of relationships, nationally that we are, emailing, that we're conversing with, that we're going outbound like any relationship would. But, we're not knocking on sellers' doors and saying, hey, by the way, I'm Brent. This is what we do. Do you ever want to sell your business? We're waiting for them to find us. And it's tough because the power dynamics, if you go outbound, are all off. I mean, we've tried it in the past. And what we get a lot of times is people saying, well, sure, like make me an offer that I can't refuse. And we're like, well, that's not really how this works. Like, that's not what we're trying to do. Like, we're trying to create a mutually beneficial transaction. And they're like, yeah, I don't need that. Like, I'm not interested in selling them. I'm like, okay, great. Now, when somebody comes to you and they've read everything about your firm, they know about you, it's like you're jumping to the 10th conversation. So it's just much more efficient on both sides for us to put ourselves out there and for people to come inbound.
Now you mentioned like you no longer can do these like $500,000 revenue deals. Like what happens with a lot of PE firms is kind of start small, but then they kind of realize like it's almost the same amount of work to buy a company that's like 10 times as big. So then they kind of move up market over time. Like, is there a sense that just like as you're more successful, you're just going to inevitably have to do bigger and bigger deals?
Yeah, well, it's funny because I think the fee model mostly has to do with wanting to go up market. So returns, I mean, if you look at returns of any private equity firm in terms of rate of return, it always decreases the larger the firm gets. Like this is not a complicated phenomenon. Like very rarely do people get more successful as they get bigger. So why do people do it? Well, the incentive is to gather fees. I mean, this is as much as anybody. I mean, it's like when your model is built on 2 and 20, that 2 is pretty attractive. And the 20
Yeah.
you have to wait for 10 plus years on to really
Yeah.
harvest. So, I mean, the incentive for most people is raise bigger and bigger funds. And as you raise bigger and bigger funds, you have to do bigger and bigger deals. We've made the decision that we will do larger deals, but only if they're relatively priced in the same ballpark the smaller deals will be in. And so we have done some larger transactions, but they've been very reasonable valuations and with families who care deeply what happens next, which is, sort of our target audience. Our fee model is totally different. So we take no fees of any kind, no reimbursements of any kind, like zero cash flow comes from the LPs or from the portfolio companies to us. So we're all self-funded internally from our own cash flow from companies. And then we take a percentage of free cash flow above a hurdle as we return cash back to investors. So we're 100% aligned. There's no way for us to make money unless our investors make more money. It's impossible.
Sorry,
that incentivizes
how do you
us.
fund operate? You mentioned you fund operations from cash flow, but where's the cash flow coming from for the permanent equity firm? It's just like permanent equity firm itself owns businesses?
Yeah. So we started before we ever took on outside capital, we started and bought businesses ourselves, right? So this is, I used to joke that I ran the world's smallest family office at one time, right? So it was all just my capital. I'd gotten an SBA loan. That's how I got started, paid that back, started cash flowing, rolled that cash into more investments. Those start cash flowing. You start rolling that cash flow. Now you pay a lot of taxes, changes in working capital. It's not like it was a lot, right? I mean, this is fairly small numbers, but that had provided the foundation and to build the team where whenever we went to raise capital, I said, look, I don't need fees. Like I already funded the team. Like we're fine. So even to the day, I mean, we do have, we have different revenue streams now coming in, but we still own companies outside the funds that help fund it. And then obviously we've got tremendous amount of cash flow coming off the investments. And so we're in a position now where we can just take cash whenever we return cash back to investors. And that's the model that we love. It perfectly aligns us, which is just radically different. And so for us, we're like pretty much the only people where unless we perform, we don't get paid. In fact, we lose money unless we perform. So for us, like we want to do bigger deals if we think they're fantastic. We want to do smaller deals if they're fantastic. Now there's some they're just a certain size, and overall with the portfolio the size it is and the revenues and profits where they are, that it just doesn't make sense. It's kind of like any organization, regardless of fee model, at a certain point, you can't do deals that you used to do. We actually think the area of the market we're in now, though, is relatively priced appropriately and better for us than even down market. I mean, you can buy something that's generating $500,000 in free cash flow for, call it 3 times multiple, maybe 3.5 times multiple. But you can go up market and buy something that's much more sophisticated, much more stable for relatively not much more. So, it's all about value is quality and price. And I think a lot of people get this wrong. Price is dependent on what you're actually buying. And something that looks cheap on the surface often is priced for a reason that way.
If you already kind of started with like a holding company, kind of like you have this like mini Berkshire Hathaway where you're buying and then you're using the cash flow of those to help you buy other companies, et cetera. Why not just keep that going? Like, and then if you need more equity, why not just like raise equity into the holding company? Why do the funds with it?
Yeah, that's a great question. Well, one, we didn't want to value the current assets. And ultimately, when you have to value current assets that we had, if we were going to create a holding company structure, and we explored doing this with some investors, the valuations never matched up because we bought it for X, they want us to sell it for Y. We think it's worth a lot more, or we wouldn't have bought it. And we're kind of throwing all our chips into this thing that's already working. It actually felt more risky to us to do it that way. We didn't like the fund structure because of the 2 and 20 model. And so really, we'd kind of given up raising outside capital until I met this guy. I don't know if you ever heard of him, named Patrick O'Shaughnessy. He was just some dude back then, but apparently, a lot of people know him now. He's become a dear friend, but back then it was just a guy who on Twitter who I met who said, "Hey, can I come visit you in Missouri?" He came and visited, and about 13 hours later, we had a great conversation. He said, "I want my family to invest in what you're doing, believe in what you're doing." And I said, "Great. There's one problem. We don't take outside capital." And he said, "Well, why?" And I said, "Because we don't want to create a holding company for all these reasons, and we don't want to create a traditional private equity fund for these reasons." And he asked me the question that, frankly, no one else had ever asked me. He said, "Well, what would it take for you to take our capital? Why don't you make us an offer?" And I said, "Okay." And so went back and designed permanent equity basically the way it is today, went back to him and he and his father and said, "Hey, here's what I'm thinking." And they said, "That looks great. Here's a couple tweaks here and there, but that looks great. Let's do it. And that's really how we started raising outside capital. And so for me, our model is the best of both worlds. We have a really long-term capital. So we have a 30-year lock on our capital. So no guaranteed liquidity for 30 years, complete autonomy over the capital. And whenever we need new capital, we just raise a new fund that basically acts as a holdco, but it's a de novo holdco the entire time. So, our first fund was in essence a $50 million holdco that we raised and deployed.
I guess so. The fund itself is basically a holdco.
That's correct.
And then in the end, like, okay, that makes sense. Okay.
Yeah.
But I assume like if you do sell, it's structured in a tax efficient way to like get the investor rather than like do a double taxation or something.
Correct. Yeah. Incredibly, it's all pass through taxation and it's incredibly efficient.
Now, I'm sure one of the companies you admire, one of the companies I deeply admire is Constellation Software. Yeah. Like, what have you learned from them?
Yeah, I tell you what, I had the pleasure of spending some time with Mark. Unfortunately,
not
recently.
You met him in person?
Yeah.
So Mark, gosh, like I would he's like one of like he's probably like the top guy I would love to meet. Yeah, but he's a little bit of a recluse. Like,
Yeah, Mark's great. Yeah, I'll never forget. I was at dinner. It was probably 2018 or 19, and I just got like a form through the website, and I look at my phone, and it was, Mark Leonard. Hi, I'm Mark Leonard, and here's what I do, and here's my cell phone number, and I'd like for you to give me a call. And I was like, okay, somebody's probably pranking me. Surely that can't just be Mark Leonard who hit my, contact form on the website. Yeah. Sure enough, it was Mark, and he had been following us for a while. And
that's so cool.
So yeah, I called him, and then he graciously, I got to go up and I got to spend some time with him and board of directors and some of his senior staff up in Toronto, and had a wonderful time. They're incredible people, incredibly sharp, and I would say is you asked me what's the thing I probably learned most from him is just that incentives really matter. I mean, one of the things I talk to him a lot about is broadly. Most people understand that incentives matter. I mean, Munger's talked about this a ton. It's kind of like cliche at this point to talk about it. But what most people don't really is kind of underneath it. What you're trying to do with incentives is stop people from doing something or start people doing something. So every time, you think about an incentive, it's what is the thing that person would have otherwise done or not done? And what is the incentive going to do to move them in a direction? And just making sure you really understand. But for that incentive, that person would have not done something or would have done something that I either want them to do or don't want them to do.
Yeah.
And, I think Mark's done a beautiful job of structuring incentives, and he would say not perfectly. I think that, and he's talked publicly about this, so I'm not giving away anything in confidence, but, I think he would say that if he had to start over again, he probably would have tweaked the Constellation incentives for their team to be more growth oriented on organic assets as opposed to acquisitions, because he's incentivized kind of them to be equally the same. And it's a lot easier to go out and acquire growth than it is to generate organic growth. And so I think, anything like that you're trying to do, you're trying to create as simple a model as possible to generate great incentives while also getting the desired result. So,
yeah. That's, one of the things though, incentives do matter. But I think one of the things that they've done super well is they have brought in people that have internal incentives that match their values.
Yep.
And so, there's only like design, if you have to constantly design the incentive around and someone's trying to like work around it, it is really hard to do. But somehow they've found these people that kind of like fit what they believe in. And they have a very interesting, very unique culture, which maybe attracts a very unique type of person.
Yeah, I love it. I think it's, again, attract the right people and repel the wrong people. Like the repelling of the wrong people is arguably more valuable than even the attracting of the right people. Because you just don't get people, you don't get actors in your system that are going to gum up the works. So I would absolutely agree with that. I like I said, I admire the team. I admire what they're doing. The other thing I learned from them, and I talked a lot about, is just standing firm on valuation, knowing what you can pay, knowing what works, not moving. And they're very, very disciplined in that. And we try to be disciplined as well. And by the way, it's easy to talk about discipline when you're not having to exert it. 2021 and 2022 for us were difficult. Really, really difficult because we were getting outbid. We didn't change the way that we bid on companies, and we were getting outbid by 50, 80% at one point pretty
Yeah.
regularly. In fact, I mean, we were told by some intermediaries that they were like, we'll never show you another deal because you're just not even in the ballpark. And we're like, guys, we haven't changed how we've been bidding these things for the last 5 years. And they're like, yeah, but the market's passed you by. And thankfully now that's come back down. But
Yeah.
man, it's tough.
Now, I assume like when you're buying these small businesses, there's like a way, at least part of your thesis is there's probably some sort of way to like techify them a bit, right? So you've got like a
Yeah.
trucking company, and then you can tech enable it and make their customers happier and allow them to operate more efficiently. Is that kind of part of the playbook?
Yeah, I would say kind of. I'll tell you a couple stories, and maybe this will illustrate the point. So one of the companies that we acquired, we couldn't figure out why sales were not working, like why sales were down, and there's a certain platform online that we were supposed to be getting a lot of sales from that we just couldn't figure out. And finally, somebody backtraced it when it was me on our team, and it looked, and by the way, all the sales were being sent to a fax machine that was not plugged in. I'm not joking. To a fax machine that was not plugged in. We literally plugged in the fax machine and orders started coming out. We had another deal that we looked at where we asked them like, hey, what are some challenges you guys face? And one of the challenges they faced was that the internet kept going out. And we're like, that's so weird. Like they're not in a rural area, they're in an urban area. And what we found out was that the head of IT had taped the spike bar to the side of a file cabinet that was tied to the router. And from time to time, the duct tape would go loose and the internet would go out for the entire thing for like 10 minutes. So the answer is yes. We try to techify some of these businesses.
But the bar is low, is what you're saying.
The bar is for most of these small companies. The bar is very low. And by the way, that's not to impugn these small companies. Like they are fair for the most part fairly wisely using their time. It's just that there's so much more problems, bigger problems to face. Yeah. They're not looking for the latest technology to implement. So yes, we come in and we try to do the most lightweight, most efficient. We're not on the cutting edge, the bleeding edge of a lot of technology, but we're also not Luddites. So we've got a team that we can see technology across the portfolio. We can see what's working, what's not, and then we can start introducing technology as it makes sense. I'll never forget. I had a conversation with a guy who he had gone to an Ivy League school, worked at a big company, super sharp guy, promoted, wanted to buy a company. He was like, I'm going to go buy this company, and I have all these grand plans. We're under LOI, and I said, great, keep in touch. Let me know how it goes. His whole thesis was he was going to go in and he was going to implement all this technology and software, and it was going to revolutionize the business. And I caught up with him about 6 months after he bought the business, and I said, hey, how's all that going? How's the revolution going on inside the business? He goes, I haven't done any of it. And I was like, what do you mean? I thought you were going to come in and install all these things. And he goes, yeah, like the sales guy quit and sales went through the floor. And then the internet stopped working and we couldn't figure it out for like 3 days. And, it was it was like
Classic.
thing after thing that happens. Right.
Yeah.
So I would say it takes actually a long time. We use the term internally about quality of earnings versus quantity of earnings. And I mentioned that before in the podcast, but it takes a lot of quality building internally to then enable you to actually implement new systems and processes, technology or not. And it takes a lot of trust. I mean, look, people have a certain way of doing things. And when you tell them like, hey, we need you to switch over this new system, there's a high switching cost. There's a lot of friction created. So you need to have a lot of trust. Is there some and relationships.
So you've got these 12 companies now, and as you is there, and so are you running them better now because of economy of scale than you were when you had 2 companies, or are you running them better just because you have more knowledge and you've seen more things that go wrong and you're more experienced?
Yeah, I would say there's very few economies of scale across disparate businesses. And in fact, we don't underwrite for that at all. I would say, we've learned that, not surprisingly, that technology is important. So we have a group that internally looks at technology across all the companies. We have a group that looks at talent across all the companies. These are, I would call specialized services that we can come in and it's part of the everything tastes like chicken layer of business, where it doesn't matter if you're operating a software business or a manufacturer or construction. You all got to have the certain same things. That's really the layer that we try to focus on. And I would say we've learned things, but there's not a lot of, like group healthcare is one of the things that we've looked at exploring. Right now we don't have one united healthcare plan. We don't have like a self-insured plan. It's one of the things we might do in the future. But again, it all comes with trade-offs. And oftentimes those aren't the biggest problems that we're facing.
Now, how do you guys deal with like labor shortages? One of the companies I'm involved with, they have about 1,000 people, and their average worker was making, let's say, $15 an hour a few years ago, and now they're making maybe over $25 an hour, same worker, just because the labor costs have gone up. And how do you guys deal with some of those types of things?
Yeah, I mean, there's no secret to it. Try to be a good employer who sees people and treats them well. I mean, everyone's looking beyond dollars, right? Because you got to pay
Yeah,
people competitively,
yeah,
whatever
for
the
sure.
market is for labor. Beyond that, though, I mean, most people are looking for meaning and looking to be respected, right? I mean, most people, even if you're working a traditional construction job, right? Like you want to be treated with respect.
I read your annual letter where like an older general partner kind of once told you that you should stick exactly to what you told your investors you would do, even if it led to like mediocre returns and pass up better opportunities. Like,
Yeah.
walk us through that and like what was going on there with that advice?
Yeah. Well, so, okay. The question is when you get outside investors and you tell them, what are they hiring? What's the job they're hiring you to do is the question. And by the way, this is not an obvious answer. You'd think that most people are hiring somebody to invest their capital to generate the highest return. Most of the times, that's actually not the case. I mean, you probably know
Right,
this,
because
but
they
like,
have a diversified portfolio themselves. It's not like all their eggs are in your basket. They've got a ton of different
exactly.
baskets that they're in. So it's really just depends on
Exactly.
what's your basket, right?
Exactly. Yes. So this is the big issue. The big issue is that if you are hired to fill a certain slot for them and you veer outside that slot, well, now all their risk profiles are off, their allocations are off. And so,
Yeah.
what this person was telling me, and by the way, it's very wise advice, is, once you take on outside capital, and I would say this is arguably true, arguably not, but this is his perspective. Once you take on outside capital, you are forgoing the ability to generate the highest returns you could possibly generate, because the highest returns are going to come from outlier investments. They're going to come from investments that by just definitionally aren't attractive to other people, that you're able to get at a better price, or that you're paying up for something that other people don't see the quality in. So you're going to do
Yep.
something from an outlier perspective to generate outlier returns. By definition, when you take outside capital and you say, hey, here's what we're going to do, we're going to take your money, we're going to invest in these types
Right.
of
We're never
things.
going to go below X thing, or you're never going to
Right.
go YPE or whatever it is.
Exactly. Exactly. And so what he was saying is the best possible thing, if you're trying to be a professional investor, if you're taking somebody's other people's capital, investing on their behalf, is to do exactly what you said you do.
Be
Exactly what you said
consistent.
you do. To be consistent, even if it means generating lower returns. For me, I have a hard time with that. Like the way that we're aligned with our
Right.
investors. I mean, I want to generate great long-term returns. And this is what we tell our investors. We say, hey, we're not a vintage of fund model. You're not hiring us to go out and deploy capital over a short period of time. We have a 10-year investment period on our funds. So we have a long time to invest capital. And when I said to him, look, we may invest all the capital in year one, or we may take 9 years to invest all the capital, or 10 years, or we may
Yep.
return some capital back to you. We only want to do good deals. And so if all the good deals come along in a short period of time, we're going to try to do all the good deals. If one good deal comes along every 5 years, we're going to do one good deal. What that means, though, is that you're breaking a lot of paradigms. And in fact, when we fundraised last time, it's been a long time, but when we fundraised, I mean, people had a lot of problems with it. It's like, do we put you into traditional PE bucket? Well, you don't return capital the way that traditional PE does, and the time horizon. You've got different aspects to it. We're returning cash flow back. How do you value that? What does the marks look like? How are we incentivized based on the marks? All the things that a traditional PE firm is set up to do. We just do things a lot differently. And so, it takes, and again, I think this is a feature of our system. It attracts the right people. It repels the wrong people. So the people who were short-term oriented, who loved debt, who said, hey, we want you to burn the ships and get it done, right? Those are the people who we said, oh, we're just not a good fit, right? And the people who are long-term oriented, who saw that compounding and treating people well over a long period of time was going to generate higher returns, those are the people who invested with us. So
Yeah.
we feel blessed by
Also,
that.
in some ways, like the higher percentage of net worth that the principals have, the general partners have in the funds, in some ways a little bit more aligned too, because you want to get good returns, but you also don't want to lose your money, right?
Right.
And so you don't want it to go to zero if you have 90% of your money in the fund. You just certainly don't want it to go to zero, but you're trying to generate as much wealth as you can too for yourself.
Absolutely. I mean, I when people ask me what I invest in, I say I have two asset classes. I have cash and highly illiquid private investments. That's it. Like we
Yeah.
don't invest
Yeah.
in anything outside our own stuff. It's just
Yeah.
all internally.
Yeah. Okay. That makes a lot of sense. So you kind of describe your portfolio as like quote unquote boring businesses, but some of them seem like incredibly interesting and unique. I mean, I think you own a matchmaking firm, you own a roller coaster manufacturer. Like those don't seem like boring at all to me.
Yeah, we kind of like jokingly use the term boring, right? It gets people's attention, and look, no one thinks their business is boring. We don't think any of our
Yeah.
businesses are boring. We joke about boring because they just make money, right? They're boring in the sense they're not exciting in terms of making money or not. They all produce cash flow, which is we think is a nice feature of a boring business. But yeah, we have really interesting businesses. We have an aerospace business that we think is really, I mean, all of them are interesting. But yeah, we have a matchmaking firm. It's the highest end matchmaking firm in the world. It's called Selective Search. If you'd asked me, well, at any time prior to purchasing it, that we were going to own it, I would have laughed. In fact, the person, Emily, who leads our deal team, she came in and she said, "Hey, sit down, shut up. I don't want to hear a word from you. I'm going to explain this business to you." And I was like, she got like 3 sentences in, and I was like, "There's no freaking way." And she was like, "Shut up. I told you, just be quiet, listen." The more she talked, the more we looked at it. Oh, it's not a dating business. This isn't like, setting up dates for rich people. This is a true matchmaking business. So you get one introduction at a time. Both have to opt out before you get another introduction. It is the people are searching for long-term monogamous relationships, like healthy relationships where these people are searching for the right things. And so yeah, it's a wonderful business, great team, and it's been quite the adventure. I mean, the stories that they have are
seems
incredible.
like there's some of the businesses you have don't seem like good for like a roll-ups, quote unquote. I know it's an evil word, but that does seem like a business where it could make sense. There could be like this, someone else has this like amazing similar type of business in Cleveland, and someone else has a similar business in Dallas or something, and you roll up, and then there's some sort of economy of scale as you kind of like, because okay, well, this person happens to be traveling a lot between Cleveland and Dallas or something, right?
Yeah.
And or their mom lives in Dallas and they're going to go visit off. So that there just seems like there's some businesses where like you could like deploy more capital, do more acquisitions, and really fuel them forward. Or how do you think about that when you're buying them?
Yeah, I mean, we're always thinking about what other opportunities there are to do combinations. I mean, the reality is in the matchmaking business, there's really only 2 or 3 firms worldwide that are like them. So they're
Okay.
not geographically focused.
I would have thought there were like thousands of them. Okay, I didn't realize that.
No,
Okay.
I mean, there's matchmakers, a lot of places. The way they do them, the systems, the way that they match, the whole thing is very unusual. Like I said, they work at a very high level worldwide. So they match people, all over the place.
So you don't have to live in the same town. So these are people who are a little bit more mobile.
Yeah, I mean, they do some really amazing. They specialize in what I would say very difficult to find or very important matches. So they have somebody who came to them and said he loves golf. He was widowed. He's like, look, I have all these other requirements, but I want the woman who I marry to be an under 7 handicap golfer. Well, that is an interesting challenge, right? And so,
I would have like turned down that business though, because is that really the most important criteria for someone you're going to marry? Like, come on, like
it was a huge part of his life. I mean, look, value judgments aside, but yeah. So I mean, so they do very interesting, unusual matches. Is I would say their specialty. But yeah, I mean, to getting back to the original question about roll-ups. Yeah, we are often looking for what other businesses can be combined. The reality is, though, that we love one of the best things about having a smaller company is there's usually a lot of room to grow organically, right? A lot of businesses that are larger do combinations because there's no other way to do it, or a private equity firm's trying to bolt on a lot of things quickly and kind of put lipstick on the pig in order to sell it to somebody else.
Yeah.
Because we have such a long-term view, oftentimes we say, okay, look, could we go and buy a competitor, or could we go into this market through purchase? Yeah, of course we could. But we'd rather just take our systems, take our people, and start something new, which takes longer, but we feel like the quality of it is a lot higher. I mean, as you know, most roll-ups die a pretty terrible death. We think that slower growth and organic growth makes a lot more sense for most of these businesses.
Now, a few personal questions. Your Twitter bio says you're a former atheist who now follows Jesus. Like, tell us a bit about that conversion.
Yeah, I believe me, I'm as shocked as anybody. I was a hardcore atheist in my 20s. It was kind of my early 20s. It was the peak of the new atheist, Dawkins
Like the Sam
Hitchens,
Harris,
Sam
Dawkins,
Harris.
like, yeah,
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 that whole crew. And look, like I just religion never made sense to me. Like if I was going to define religion as there's a set of rules, and if I do them, I'll get favor in this life and the next. How in the world, like, do I know if I did enough of them right? Like, did I do them the right way? What if I don't get favor in this life? Does that mean I'm doing them the wrong way? It just never made sense to me, and so I just wholesale rejected it. My 20s were filled with pursuing, I would say worldly prizes, and I got a lot of them. And at the end of my 20s, I was just empty. I mean, I feel like I can relate to. I mean, look, so many people have talked to this. Tom Brady after he
yeah,
won the Super Bowls. I mean, it feels like every time somebody wins anything big, they're like, "Oh crap, I'm the same person I was before."
yep.
I felt the same way. I can remember in my late 20s, I just everything tasted dull. Everything was kind of gray. And it was about that time that I started meeting people who there's just something so different about their lives. And I asked them, I'm like, what do you have? Like, what is the thing that you have that I don't? They were like, oh, I follow Jesus. And I was like, you got to be freaking kidding me. You follow Jesus? What? What does that even make any sense? Well, they started talking to me about it. I started reading things. And lo and behold, I didn't understand that Jesus is a singular figure. I mean, unique. Put aside his divinity for a second. I mean, he's the greatest leader that's ever lived by the number of followers, right? I mean, by a mile. Like, there's no one
Yeah.
who's ever had more followers. And so, um, they challenged me, and I've challenged other people. It's like, just study who he was, study why he said the things he said. Like, he created a whole new paradigm and it revolutionized the Western world. Now, I mean, we're all swimming in Christian values and Christian culture, and so I started really looking at it, and then ultimately, I determined through extensive study that the resurrection was true. I mean, that's ultimately what it came down to for me. The resurrection, I believe, is verifiable and historically accurate, and if that's the case, then it validated what Jesus said and who Jesus was. And so I ended up following Jesus. I apprenticed under Jesus, and my life has been transformed as a result of it. And it's amazing. It's been amazing. So
Yeah, and like a lot of people who convert in some ways, like you, like they become they're more evangelical, they're more willing to talk about it, etc. It seems like you're more open about it than maybe somebody else who's like they've kind of always been that way. It's like more of a part, like you're more out there probably because of the conversion, right?
yeah, well, somebody asked me the other day. They said why do you share about your faith? And I said, okay, what if I had cancer and I had been cured of cancer? And then somebody else comes to me and says, hey, I have cancer and I care about them. I would want to share that.
Of
Like, I would
course,
want
yeah,
to
that's what
share
people
the
do.
thing.
That's
I
why
mean,
people. So that's the same reason why people even like share that they're a vegan or something too, right?
right,
Because they're like, oh, it helped
right.
me. I think it'll help you, or like I meditate or whatever it is, right?
Absolutely. Yeah. And so I feel like my life has been transformed, and the things I've learned and the things I've seen at this point it's been incredible. And I mean, it's not without struggle and heartache and all that, but it's well worth it. So I appreciate you asking about it.
Yeah, yeah, absolutely. And what's it like? Like you're in business in Columbia, Missouri. I wouldn't say it's the top 10 town that people would talk about as like building like a a core acquiring entity. Like what's it like
Yeah.
building a business there?
Yeah, that's a great question. Yeah, I would not call us the center of the financial universe by any means. I love it. For us, the quality of life here. It's a college town. Mizzou's here. University of Missouri's
Yeah.
here. It's been wonderful. It's been challenging in some ways there's not other firms in town that we trade talent with or anything like that, right? So it's like
Yeah.
we're either importing talent or we're home growing it. In some ways, it's been great. I mean, originally it was really hard to get people to take us seriously being from Columbia, Missouri. Although that we got some weird street cred initially as being in agriculture, even though I've never like really been on a farm before in my life, just
Uh,
because we're from Missouri and people just assume that if you're from Missouri you must know agriculture. So
Good point.
um,
Yeah.
yeah, but yeah, I mean, now I would say it's a differentiator for us. I mean, people certainly remember us. I mean, it's kind of Missouri's kind of neutral. Like we're like the Switzerland of the United States, right?
No
like
one dislikes Missouri.
yeah,
right?
most people haven't been here. So like the thing you
yeah.
fly over and look out of the airplane window, right?
Yeah,
So,
exactly.
So whenever, regardless if we're on the East Coast or West Coast or South or North, like people are kind of like, oh, okay, well they're from Missouri. They, I think we get some like pass on skepticism. So yeah, it's been good. I mean, I'd say the hardest part is just, hiring people that want to move here. It's definitely a selection bias that's been great.
Yeah,
it's just been it's been a gating factor for sure.
What's a conspiracy theory that you believe?
Oh man. Well, I'm gonna have to go back. I think Jesus is Lord, right? I mean, most people would call that a conspiracy theory.
That would be a core conspiracy theory for sure.
The greatest conspiracy theory in history.
Yeah.
I mean, by the way, the Apostle Paul in the New Testament says, if the resurrection isn't real, then we are to be pitied. Like we are fools. Like what we are doing is a waste of time. And so it really all comes down to the resurrection. And I believe Jesus is Lord.
Okay. Well, yeah, that's definitely a really good one. Last question we ask all of our guests: what conventional wisdom or advice do you think is generally bad advice?
Man, I feel like this dominant thing now is to like be you, like find you. Like every Disney movie is like be more you, find more you. Like you need to find your true inner self and express yourself. And if you express yourself and find the real you, then you'll be happy and all your dreams will come true. The problem that I have with that is like, I've been like 30 different people in my life. Like, I don't know what the real me is. And by the way, the real me shifts and changes. And when I think about the times in my life when I have been the truest me, the realest me, is when I've been least enjoyable to be around. Like, Blaise Pascal calls it incurvature, where you're like curved in and on yourself. And I think this is where you get this like whole like self-care movement where it's like all me. You get these relationships that it's like, well, you get married so the person can serve you. If your friends aren't serving you the way you want to be served, you just drop them, right? Think about that for a second, though. Think about how twisted and messed up that is. If all your relationships are there to serve you and the only thing you're trying to find is just more you, it's going to be an ever-shifting pile of sand. Your relationships are never going to be long-term. You're never going to be challenged. You're never going to grow. It sounds like hell to me. And so anyway, so I would just say is I want to be less me. And I want to live up to an eternal standard is what I would say. And that's the more that I live into that, the more, ironically, the more me I think actually comes through. So
that's super interesting because you're like people change a lot. It's also just like it also just how you react to other people probably now changes because it's like well they aren't who they are either like because they're changing. Right. It's like every single person is like, I'm totally different than what I was 10 years ago. Like, and I hope so. Become like, in some ways, very different. Like, I'm like related to that person, but I'm not even sure. I'm not even sure I'm like the brother of that person. I might be like the cousin of the person from 10 years ago. Right.
Exactly.
Like,
exactly. My wife is married like 4 men and they just all happen to be me.
Yeah, totally. Yeah, exactly. Which is hard to like with a relationship with other people because you have to accept if you're accepting yourself as changing, you have to accept they're changing as well. And then we're all kind of like, so it's not like if your wife had 4 yous and you had 4 wives, okay, now you have like 16 pairs or something of relationships that's happened over time potentially.
Which is beautiful. I mean, that's what makes it incredible. So yeah, I would just say is for God's sakes, don't be more you.
Okay, I love that. That's awesome. That's great advice. All right, well, thank you, Brent Beshore, for joining us on World of DaaS. I follow you at Brent Beshore on Twitter. I definitely encourage our listeners to engage you there. This has been awesome, a ton of fun, and I'm a huge admirer of yours. So thank you for being on the show. Hey, thank you so much, sir. I really appreciate it. Thanks for having me on. And if you're a super data nerd, go to worldofdaas.com. That's DAAS, worldofdaas.com, and sign up for our weekly Data as a Service news roundup newsletter. Thanks for listening. If you enjoyed this show, consider rating this podcast and leaving a review. For more World of DaaS, and DaaS is DAAS, you can subscribe on Spotify or Apple Podcasts or anywhere you get your podcasts. And also check out YouTube for videos. You can find me at Twitter at Auren, that's AUREN, Auren, and we'd love to hear from you.